Namaskar, very good morning, good afternoon, good evening based on what time you're watching this video. Friends, now we are going to see the most important topic of your indirect taxation, which is input tax credit. Obviously, while discussing many other topics, we have touched this topic called as input tax credit because I say it as backbone of your indirect taxation. So here and in almost all the chapters you will find a reference of ITC, but now exactly we'll narrow it down and see what are all the provisions that are covered in your ITC. To start with, your input tax credit main provisions. Basically, the main provisions are section 16 and section 17. So as we can see, these are the two main provisions that will be impacting ITC on day-to-day basis. Now you might wonder what about the other provisions, we'll discuss, but main provisions are section 16 and section 17. Section 16 talks about eligibility and conditions of ITC, and this section 16 is always to be read along with your rule 36 and rule 37. Basically all the conditions, including what are the documents required for taking ITC and other conditions, are discussed in section rule 36 basically. Rule 37 also discuss about the condition, one of the condition of payment by the recipient to the supplier within the prescribed time. If you're not paying to the supplier price plus tax within a particular time, you have to reverse your ITC. That is discussed in your rule 37. So basically you're talking about section 16 read along with rule 36 and rule 37 for taking input tax credit. For taking input tax credit. Let us call it as full ITC. For taking your input tax credit, full ITC. Now one might wonder then what is covered in section 17. Section 17 is detailedly given in the next page, where section 17 we have bifurcated into two. One which is proportionate ITC, the other one which is blocked ITC. Now please understand that 17 is split into two parts. If at all I want to make things more simple, I can call it as partial ITC, section 17 1 to section 17 subsection 4, and blocked ITC where you cannot take any ITC, no ITC. So if at all I want to take full ITC, I have to satisfy section 16 read along with rule 36 and rule 37. And if at all there are certain items on which I cannot take the credit, it is given in section 17 subsection 5. And here friends, you don't have any rules. It is basically the provision, only the concepts are there, so no rules. Section 17 subsection 5 block credit, that's it. You won't find any rules behind below block credit. Whereas when you talk about proportionate credit, which is section 17 subsection 1 to section 17 subsection 4, it talks about taking partial credit. Few credit you take, few credit you cannot take. Rather, you have to split up and find that what portion of credit you can take, what portion of credit you cannot take. Obviously there's a formula. That formula is discussed in your rule 42 for common inputs and input services, and rule 43 for common capital goods. I'm using the term common. Don't worry, when we see 42, 43, you will get to know what is this common input services and common capital goods. So if you're working your proportionate ITC for common inputs and common input services, it is your rule 42. If you're working your proportionate ITC for your common capital goods, it is rule 43. Friends, at this juncture, I would like to tell that not in all the cases for all the companies will work out 42, 43. No. It is worked out only in a scenario where you're talking about a company which is dealing with multiple products, few are being taxable and few are being exempt, or there are input services capital goods which are used for business and as well as non-business purposes. So it is not affecting all the companies per se. It will affect few companies per se. Mostly many companies, when you walk through any questions, when you see, you will not find the application of 42, 43. Now for banking sector, they have a beautiful option. When you're talking about banking sector, it is banks, financial institutions and non-banking financial companies. We are calling that as banking sector. They will obviously have 42, 43 because their main income happens to be interest, which is exempted as per your notification 12 bar 2017 CT rate read along with notification 9 bar 2017 IT rate. It is exempted. There are other incomes of banks like your processing fees, NEFT charges, RTGS charges, checkbook charges, etc., documentation charges. They are all taxable. So you have one portion which is taxable, one portion which is exempt. So obviously for banks, your proportion ITC will jump in. So when you're talking about banks and others, where your rule 42, 43 or partial ITC is working out, things are very different. Things are very different. For banks, they have an option either to go for normal rule 42, rule 43, 42 for common inputs and input sources, 43 for capital goods, or they have an option to go for simplified rule 38. A simplified rule 38. So either or. And when this rule 30 talks about common inputs, common input sources as well as common capital goods. When you're talking about other companies who are affected by your proportionate ITC, not everyone is affected, as I said. Those companies who are affected by proportionate ITC, they do not have any option. They have to go for only rule 42 for common inputs, input sources, and rule 43 for common capital goods. So that you have to keep in mind. Now talking about your 42, 43 and 38, things are pretty clear. Now as already discussed, please understand that this concept of proportion ITC will not be affecting everyone, it will be affecting a few. Whereas for all the companies, always you'll always see section 16, rule 36, rule 37 will be applicable for every companies. Section 17 subsection 5 blocked ITC will be applicable for every company. Always you are going to see these provisions. Proportion ITC, few companies may be impacted, and when it is impacted, which rules to be seen, we have discussed here. Now coming back to the other provisions, section 18. When you talk about section 18, it is a one-time situation cases where normally in the normal flow or during the lifetime of the registered person, section 18 may not have any impact. At certain typical cases, say for example your goods were taxable, suddenly they are becoming exempt, or vice versa, your goods are exempt, goods or services are exempt, suddenly they are becoming taxable, or you are switching over from regular scheme to composition scheme, or composition scheme to regular scheme, or there is a merger, or there is a demerger, or there is a sale, etc. One time situations. All the situations that I have said are not going to occur very frequently, rather they might never occur during the lifetime of a registered person. Tag goods being taxable, now exempt, or they were exempt, now being taxable, or from composition scheme to regular scheme, or from regular scheme to composition scheme, or sale of business, or merger, or demerger, or you are talking about sale of capital goods. So these are the situations which will be discussed here. Now in your section 18, there comes two possibilities. One, you are claiming the credit. If you are claiming the credit in those special situations, the rules to be referred are rule 40, 41, 41A. There could be a scenario where you are talking about reversal of ITC. For that also rule 40. Rule 40 talks about both one portion availment, one portion reversal, and rule 44. So section 18, I do repeat this sentence that it is not going to affect the registered person normally. It is a one-off situation where you might be covered by section 18, and when such situation comes up, there could be availment of credit, there could be reversal of credit. If at all it is availment of credit, please refer rule 40, 41, 41A. If it is about reversal of ITC, you may have to refer rule 40, rule 44. Right, that is section 18 for you. Now, when you are talking about the other provisions, section 19 read along with your rule 45 talks about job worker. So what happens when you are talking about job worker who can take the ITC? So it is job worker situation is all discussed in your section 19 read along with your rule 45. Right, ITC when job worker is involved. Section 19, rule 45. Section 20, section 21 read along with your rule 39 talks about ITC when you're talking about input service distributor. So when you have multiple registration, you might have to take one more registration called as input service registration, which I loosely call it as head office registration. A loose term that can be used is head office registration till you understand what is exactly ISD. So this head office registration, how that head office will distribute the credit to their branches is discussed in your section 20 read along with section 21 read along with your rule 39. So these are very typical cases. They will be there only for certain companies where job work is there or where ISD is there. Otherwise, in normal course, 19 may not be not be relevant for a trader who's not having any job work, not be relevant for manufacturer who's doing manufacturing on his own, no job worker, etc., etc. Even service provider, it may not be relevant to a service provider who's not giving anything on job work. Right, 2021 may not be related to a person who's not having multiple registration. So this will impact only certain class of persons. So that is discussed in your section 19, 20 and section 21. So this is overall bird's eye view of what we are going to discuss in this ITC chapter. Now moving on to the definitions. So we'll start with the definitions of the terms that are going to be used in this chapter. Now, friends, first let us understand what is goods and what is services. Only when you understand what is goods and what is services, we can see what do you mean by inputs, what do you mean by capital goods, and what do you mean by input services. As discussed, all the definitions which are relevant will be discussed only in section 2. Now please understand that this entire chapter you have to look from the angle of recipient. So please make it very clear. You are looking this entire chapter from the angle of recipient. It is as if as you are getting the goods or you are getting the services. Right. So basically you are looking at your debit side of your manufacturing account, trading account, profit and loss account. You are looking at fixed assets where you are spending something. Right, so you're talking about debit side of your manufacturing, trading or profit or loss account, or you're talking about assets, fixed assets, debit side. Right, whenever you're talking about assets, obviously it will be on the debit side. You're talking about the fixed assets. You have spent something on purchasing capital goods. So please understand that ITC, this entire chapter, you're looking from the angle of receiving the goods, whether it is inputs or capital goods, or receiving the services. You're paying for them. Receipt. When I receive the goods or receive the services, I'll pay for them. So you're looking from that angle. Now, when I get the goods may be inputs or capital goods. When I get any services, the service is always input services. Right. So when you talk about capital goods in terms of section 2 clause 19, capital goods means goods the value of which is capitalized in your books of accounts. The value of which is capitalized in your books of accounts. So if at all you are capitalizing the goods in your books of accounts, it is capital goods. To put in a very simple terms in your accounting language, if at all you are getting any goods and you are taking it to a balance sheet, if you are getting any goods and you are taking it to your balance sheet, then you are talking about capital goods. If the goods, you are purchasing the goods and you are not capitalizing in your books of accounts, it is not going to balance sheet, it is going to your manufacturing, trading and profit and loss account, then they are inputs. So if you see the definition of inputs in terms of section 2 clause 59, it is any goods other than capital goods. You're talking about any goods other than your capital goods. So when you talk about goods, things are pretty simple. When you're getting the goods, see whether they are going to your balance sheet, then it is capital goods. If they are not taken to balance sheet, they are taken to manufacturing account, trading account or profit and loss account, they are nothing but inputs. So when you get some services, whether these services are going to your profit and loss account, when I tell profit and loss account, I start with manufacturing account, trading account or profit and loss account, or they are going to your balance sheet, it doesn't matter, they still are your input service, any service. It includes even capital service, which means whether you take it to your P&L account or whether you take it to a balance sheet, they will be called as input service. There is no bifurcation of input service and capital service. It is only input service. Right. Now, when you see all these three terms given in terms of section 2 clause 19 capital goods, section 2 clause 59 inputs and section 2 clause 60 input services, that's a common condition which is given that these capital goods, inputs, input services should be used or intended to be used. Either they are actually used or the intention is to use it in course or furtherance of business. Right, there's a huge difference. If you look at the language, they are telling that it should be used or intended to be used, present as well as future, in course or furtherance of business. In course or furtherance of business means in normal course of business while running the business, or in furtherance of business, which means it may not be immediately connected to business. It may be helping to grow your business. Say for example, certain R&D expenses, research and development expenses. Now it may not giving you any business, but in future it may give you business, right? So this you need to understand. And the moment you're talking about whether your inputs or capital goods or input services, please understand one very important fact. You can take 100% of ITC in the month of receipt itself, even if it is capital goods. So normally you have a feeling that capital goods, the ITC will be huge. Even if the ITC is huge, the moment you purchase that capital goods, you can take the credit in the same month itself. So whether it is inputs or input services or capital goods, the moment you purchase those items, you can take the 100% credit in the same month. This I am specifically telling because in the old indirect taxation regime, things are not the same. For capital goods, you cannot take the credit fully. You have to take it installment. But now in GST, 100% credit, whether it is inputs or input services or capital goods, you can take it in the month of receipt of that inputs or input services or capital goods, subject to satisfaction of other conditions. Now you may wonder, when you can take 100% credit, whether it is inputs services, capital goods, then why to define them? Because when we see the provisions of ITC, you'll find that at many places treatment is separate for inputs, treatment is separate for input services, treatment is separate for capital goods. For that purposes, there is a need to differentiate what is inputs, what is input services, and what is capital goods. Now moving on to the other definition, as already said, please keep this point in your mind that when you are seeing ITC chapter, the focus is only on receipt of goods, the receipt of services, purchase of goods, purchase of services, your expenses. Whether that expenses is sitting your manufacturing account or trading account or profit and loss account, or it is going and sitting in your fixed assets balance sheet, right? So you're basically focusing on your inward supply. So section 2 clause 67 defines what is inward supply. Inward supply means your receipt of goods or services. You are receiving the goods or services, whether by way of purchase or by way of acquisition or any other means. You are getting the goods, whether you are purchasing it or acquiring it, or it can be taken free of cost, right? But another important aspect is it may be with consideration, without consideration. So you are getting the goods or services, you are receiving the goods or services, you may have purchased them, you may have acquired them, or you may have got them by any other means, including gifts. You might have got it free of cost. You might have paid for it with consideration, or you might have got it without paying the consideration. So the term inward supply is very, very wide. Let us try to understand this with the help of an example. If I tell that there are free samples on which ITC is availed is given by Reliance Limited to Tata Limited. So Reliance Limited is giving free samples to Tata Limited. Basically, who's the supplier? Reliance Limited. Reliance Limited is giving free samples to Tata Limited. No, Reliance Limited is the supplier, Tata Limited is the recipient. Now, if you look from the angle of supplier, you'll find that Reliance Limited has to pay output tax. Why? Because Reliance Limited is giving something free of cost to Tata Limited, on which Reliance Limited has taken input tax credit. So it is deemed supply in terms of para 1 schedule 1. Deemed supply para 1 schedule 1, permanent transfer or disposal of business assets on which ITC is availed. So Reliance Limited will have to pay output tax. Though it has given free of cost to Tata Limited, it is not getting any consideration. Reliance Limited has to pay output tax. Now, as far as Tata Limited is concerned, it is inward supply for Tata Limited. Can Tata Limited claim ITC? Yes. Though it is not paying any consideration, it can claim ITC for a very simple reason. You are talking about receipt of goods. Okay, the goods are being received. The goods are being received. Is it by way of purchase? No. Is it by way of acquisition? No. It is by way of any other means. Whether there is consideration? No. It is without consideration. So it is covered in this any other means without consideration. So Tata Limited can enjoy your input tax credit. Now Reliance Limited, why it has to pay output tax? Because it is deemed supply. Why? That is permanent transfer or disposal of business assets on which Reliance Limited has enjoyed ITC. So Reliance Limited will end up paying your output tax, though there is no receipt of consideration, and Tata Limited will end up taking input tax credit, though it has not paid anything for it. So now you're looking one from the angle of Reliance Limited, not talking about ITC but talking about output tax deemed supply, and one you're talking about Tata Limited from the angle of input tax credit, where you're talking about receipt of goods. The beauty of this transaction is there is no payment of consideration by Tata Limited to Reliance Limited, but still Tata Limited is paying output tax, it is giving tax invoice, still Reliance Limited is paying output tax, giving tax invoice, and Tata Limited can enjoy input tax credit. So from the angle of Reliance Limited, we were focusing on deemed supply, payment of output tax. Tata Limited, it is all about receipt, taking input tax credit. So this transaction will involve tax invoice because it is deemed supply. Reliance Limited will pay output tax and Tata Limited will take input tax credit. So that is the definition of inward supply. We have tried to understand inward supply in a very wider term to and take this example so that you are very clear with what is this definition all about. Now, we are also seeing the definition of outward supply, not for the purpose of ITC. Understand that this outward supply definition we are seeing because it is indirectly connected with your ITC. If at all, you will be seeing in your input tax credit, if you are paying output tax on your outward supply, you can take input tax credit on your inward supply. If you are not paying output tax on your output supply, you cannot take input tax credit on your inward supply. So this is a basic thumb rule. We will be seeing it further. Pay output tax on your output supply, get input tax credit on your inward supply. If you are not paying output tax on your output supply, you cannot claim input tax credit on your inward supply. So it becomes necessary to understand what is outward supply. Though we are talking about outward supply, ultimate objective is to understand related ITC. So if at all I am dealing with two products, supposing I am talking about two products. If at all I am dealing with two products, say I am talking about final product 1 and final product 2. The related input 1 and say input 2. On final product 1, if at all I tell that final product 1 is having say 0% is the rate of tax, final product 2 is having say 18% of the rate of tax. On final product 1, if I am not going to pay any output tax, and final product 2 I am going to pay output tax. On my input where there is a tax, on input 1 I cannot claim input tax credit, though it has come with GST. I cannot take input tax credit. Supposing this has come with GST of say 100 rupees plus 18. Even input 2 has come with 100 rupees plus 18. Now in the first case this 18 rupees I cannot take ITC. In the second case this 18 rupees I can claim input tax credit. So in the first case my cost would be 118. In the second case my cost would be only 100 because I can take ITC. Right. So this is my purchase invoice or expenses invoice or capital goods invoice. I have to check, am I paying output tax on my outward supply? If I am not paying output tax on my outward supply, related ITC, though it has come with GST, I cannot take, my cost will increase. If I tell that on my outward supply I am paying output tax, on the related inputs I can take input tax credit and my cost will not include GST portion of my input services or capital goods. So for that purposes we are seeing the definition of your outward supply. And outward supply definition is very similar to the definition of the term supply which you have seen in section 7. Outward supply in relation to a taxable person. Outward supply is always in relation to a taxable person, means what? Supply of goods or services or both, whether by way of all the items that are used there, whether by way of sale, transfer, barter, exchange, license, lease, rental, disposal or any other mode. So you'll be finding all these items: sale, transfer, disposal, barter, exchange, license, lease, rental, or any other mode. Agreed, made, or agreed to be made by such person. Either it is made by such person or agreed to be made by such person in course or furtherance of business. It is exactly the definition of the normal term supply, general understanding of supply. So it can be by way of sale, transfer, disposal, barter, exchange, license, lease, rental, any other mode. It is either made or agreed to be made. And obviously when you're talking about normal supply, actual supply, it should be in course of furtherance of business. So it is, the understanding of that is taken from the normal understanding of the term supply. So this is all about your inward supply, section 2, clause 67, outward supply, section 2, clause 83. Now friends, let us try to understand the definition of input tax and input tax credit. First, understand that, again, I am repeating this again and again so that when you are entering your ITC chapter, you are very clear. When you are talking about input tax, you are focusing on your purchases or your expenses or your capital goods. So either you are seeing the debit side of your manufacturing account or trading account or profit and loss account, or you are seeing fixed assets in balance sheet. Right, so it is all about your inward supply. So when you're talking about inward supply, what do you mean by your input tax? Input tax in terms of section 2, clause 62, in relation to a registered person, you will find the difference. When you're paying output tax, you will see the term taxable person. It is all about payment of output tax. But when it is all about input tax, you will find the term registered person. We will understand in depth when we are starting with section 16 and rule 36, rule 37. Right. So input tax, if you want to take input tax, you should be a registered person. If you're not a registered person, forget about input tax credit. But while for paying output tax, whether you're registered or not registered, you have to pay output tax. You should be a taxable person. If you're registered, well and good, you can collect from the customers and pay to the government. If you're not registered, you're not collecting from the customers, still you're required to pay to the government if you're a taxable person. Right. So things are pretty clear for government. Government tells that when assessee has to pay to the government, whether he is registered or not registered, he has to pay to the government. But when he is to take input tax credit, the benefit, then government tells that no, you should be registered to take the benefit. Only then we'll be giving you input tax. Now understand, when you're talking about your input tax, it is CGST, SGST, UTGST, IGST. Now, if at all you're talking about, for this example, I'll be the recipient. Say for example, I'm in Tamil Nadu. I'm taking the goods from a supplier in Tamil Nadu. That supplier will charge me CGST, SGST. So basically, let us assume that I'm there in Tamil Nadu. I'm purchasing from another person, Mr. A, who's there in Tamil Nadu. I'm purchasing from Mr. B, who's there in Maharashtra. I'm purchasing from Mr. C, who's there in Tamil Nadu but under composition scheme. They are all under regular scheme. Right. So what happens in all these scenarios? D. I'm purchasing from Mr. D, who may be there in Tamil Nadu or Maharashtra, but he is supplying me something which is taxable under RCM. Which is taxable under RCM. He is registered. I am purchasing from Mr. E, who may be there in say Tamil Nadu or Maharashtra, but he is unregistered, and this transaction is also attracting RCM. So to put it very clear, the initial 3 transactions were taxable under FCM. Or I am importing something. I'm importing something, say from Mr. F of USA. So I'm importing something and I'll be required to pay import duty. Now, these are all the possible understandings. Not only we are trying to understand the meaning of input tax and input tax credit, but also we are trying to understand what are the documents that will be there. Please understand, in the first case, the entire focus is on the recipient. These are all my purchases. I am there located in Tamil Nadu. I am there located in Tamil Nadu. So all these items I am purchasing. Now please understand that when I am purchasing from Mr. A who's under regular scheme in Tamil Nadu, he will be giving me tax invoice. The document that he will give me is tax invoice. And what tax he'll be charging? He'll be charging CGST plus SGST. Can I take the credit of that? Yes. I will be allowed to take input tax credit of the same. I will be allowed to take input tax credit of the same. The opposite person will be charging me CGST and SGST, and of that particular item I will take input tax credit. If I purchase from Mr. B of Maharashtra, again this person also will give me something called as tax invoice, and now he will be charging me IGST. He will not be charging me CGST, he will be charging me IGST. This input tax credit also I can take. So whether I am purchasing from Tamil Nadu where the supplier is charging me CGST, SGST, or purchasing from Maharashtra where the supplier is charging me IGST, I can take the credit, and the documents that they will be giving me is tax invoice. The documents that they are giving me is tax invoice. It may be even debit note or otherwise called as supplementary invoice. Now, Mr. C is in Tamil Nadu and he is under composition scheme. He is paying tax. He is paying tax. Please understand that the document that Mr. C will give is bill of supply, and he will be paying only CGST plus SGST, but he cannot collect from me. So if you understand composition scheme, he will pay tax to the government, but he cannot collect from me. So he will not be giving me tax invoice, he will be giving me bill of supply. That bill of supply will not have any tax, though this person will be paying tax CGST, SGST, but that bill of supply will not have tax. Can I take ITC of that? No. As that bill of supply will not have any tax, I cannot take ITC of the same. Please differentiate Mr. A and Mr. C. Mr. A was giving me tax invoice, charging CGST, SGST, so he collected from me and paid to the government. I can take ITC. Whereas Mr. C, he will pay CGST, SGST to the government, but he cannot collect from me. So in his document bill of supply, he will not be putting CGST, SGST. I cannot take any credit. Now, when you talk about the next example where you're talking about Mr. D who's registered, this person will give me tax invoice. This person will be giving me tax invoice, and he will tell that recipient, you have to pay under RCM. He'll be giving me tax invoice, but he'll tell that I am not going to pay tax to the government, you pay tax to the government. And as the recipient, RCM is very simple. I have to pay tax by cash ledger one hand, I'll get the RCM credit in other hand. So I need to pay RCM by one hand, and that RCM credit, that RCM ITC I'll be getting in other hand. So after paying of RCM, I'll be getting RCM ITC, but the document will be that of supplier Mr. D. He'll be giving me tax invoice, but he'll not be collecting tax from me. He'll tell that, see, for this transaction you have to pay tax. I will pay RCM tax, one hand cash ledger, I'll get RCM input tax credit, other hand credit ledger. Now, Mr. E, he might be in Tamil Nadu, Maharashtra, he is unregistered. Again, this transaction is attracting RCM. Please understand that Mr. E is unregistered, so he cannot give me tax invoice. I myself will be raising something called as self invoice. I myself will be raising something called as self invoice. Can I take the credit? Yes. As far as RCM is concerned, I will pay RCM one hand cash ledger. Immediately I will take RCM input tax credit, other hand in my credit ledger. So whether the supplier is registered or whether the supplier is unregistered, whether he is in Tamil Nadu or Maharashtra does not makes any difference. I have to pay RCM. If I have to pay RCM, I have to pay by cash ledger one hand. Immediately same month I will be getting RCM input tax credit in my credit ledger the same month, subject to satisfaction of other conditions. So this point is very clear that I will be getting RCM input tax credit after paying RCM. So first I have to pay RCM tax by cash ledger one hand, then the same month I will be getting RCM input tax credit other hand. The difference is, if that supplier is registered whether in Tamil Nadu or Maharashtra, he will give tax invoice and tell that recipient you have to pay RCM. If he is not registered, he cannot give tax invoice. Recipient himself has to raise self invoice. And finally, if I tell that I am importing goods from USA, understand that now I need to pay import duty. The document that I am going to file would be my bill of entry for home consumption, the customs document I will be filing. So I will be filing customs document. What I will be paying is, I will be paying customs duty, basic customs duty plus social welfare surcharge plus IGST. So I will be paying customs duty. So what document I will file is bill of entry for home consumption, and I will pay BCD, SWS plus IGST, customs duty. This is nothing but your customs duty. But when you are talking about credit, I will get the credit only of IGST portion of customs duty. IGST portion of my customs duty. So I will not get the credit of BCD. I will not get the credit of SWS, social welfare surcharge. I will get the credit only of IGST portion of customs duty. So I have to pay basic customs duty, social welfare surcharge, IGST. These are all normal import duties. But the credit that I will get is only of IGST portion of customs duty. I will not get the credit of BCD, SWS. Now this entire example will not only make you understand the concept of input tax credit, but also make you understand the concept of your documents. Understand that input tax in relation to a registered person means tax charged on supply of goods or services made to a recipient. Tax charged on supply of goods or services made to recipient, which means you are talking about Mr. A of Tamil Nadu giving me certain goods or services, or Mr. B of Maharashtra giving me certain goods or services, whether they are charging CGST plus SGST, CGST, UTGST, or they are charging CGST plus they are charging IGST. I can take the credit. It will include tax payable under RCM. So RCM, as I said, I'll pay RCM one hand cash ledger. Immediately I'll get RCM input tax credit, whether the supplier is registered or unregistered, or whether is in Tamil Nadu or outside, other state outside Tamil Nadu, right? So things will remain the same, that I can take the credit. It also includes IGST portion paid on import of goods, which means when I import the goods, I'll be paying customs duty, which is basically basic customs duty, social welfare surcharge, and IGST. But I'll not get the credit of entire thing. I'll get credit of IGST portion of customs duty. It will not include composition tax. As I said, composition dealer will pay tax to the government but cannot collect tax from me. He'll be giving something called as bill of supply, and though he is paying tax to the government, he cannot collect from the customer, that is recipient. He will be giving me bill of supply which will not have any tax. I cannot take any credit, so it is not covered in the definition of input tax. Please understand that this is the understanding of input tax in terms of your section 2 clause 62. What is input tax credit? Happens to be the simplest definition in terms of section 2 clause 63. If I can get the credit of that input tax, then it is input tax credit. See, I am purchasing few goods from Tamil Nadu or Maharashtra from outside India. If I am eligible for credit, then it is input tax credit. If at all these items are say blocked under section 17(5), supposing I am purchasing food food items, which is blocked under section 17 subsection 5. So the hotel will charge me CGST, say CGST plus SGST. So it is my input tax. It is my input tax. It is covered here. Tax charged on the supply of goods or services made to the recipient. But I cannot take the credit. Supposing I purchase an item which is blocked under section 17 subsection 5, block credit. So when I purchase food from a hotel or a restaurant, to be very specific, a restaurant, that restaurant will charge me CGST plus SGST. So it is nothing but tax on supply of goods or services to recipient. So it is covered in the definition of input tax, but I cannot get the credit of that. It will be added to my cost. So it is not input tax credit. Though the tax charged by the restaurant happens to be my input tax, I cannot take the credit. If I cannot take the credit, it will be added to my cost. So it will not be termed as input tax credit. If I am eligible to take the credit of that input tax, it is input tax credit. Now when we are going to see input tax credit, we will bifurcate our input tax credit into two portions. One is taking input tax credit, which we call it as availment of credit. One is using that input tax credit, which we are calling it as utilization of credit. This is not the definition, this is understanding. When you're talking about availment of input tax credit, understand that I can take the input tax credit only when I satisfy certain conditions. We are going to see in total 12 conditions. Only when I satisfy the condition, I can take the credit. Whereas utilization of credit, there are no conditions. Once you take the credit, you can use it, but there are certain restrictions. You have to do this, you cannot do this. There are restrictions. It's not condition. Condition means entry itself is prohibited. If you satisfy the condition, come inside. If not, you cannot come inside. Restriction means you have already come inside. Now, you have to do certain things and you are not allowed to do certain things. Right? So, we are talking about restrictions. They are not conditions, they are restrictions. Being eligible for your CA exams is condition. So, you have to do this, you have to do that. That is condition. When you are inside the exam hall, you cannot scribble on the question paper, etc. That is all restriction. Now, when you are talking about availment, you have to satisfy the condition, then you can take the credit, and you have to take the credit within a time limit. So, one of the conditions is you have to avail the credit within a particular time limit. Whereas, when you are talking about utilization of credit, once you take the credit, when you are using it for paying output tax, there are no conditions, there are restrictions, and you can use the credit without any time limit. So once I have availed the credit, I can use the credit today, tomorrow, after a year, after 2 years, after 5 years, after 10 years. There is no time limit. Only for taking the credit in credit ledger, there is time limit. For using it for paying output tax, there is no time limit. Please understand that credit is always availed on your inward supply of inputs, capital goods or input services. It is taking the credit. And this credit utilization means you have to pay output tax. For paying output tax, you are using your credit ledger. To put in a very simple terms, supposing you are having say input 1, input service 2, capital goods 3, input 4, etc, and you are having a final product. Right, so using all these, you are having a final product. There is output tax payable on it, and there is ITC, which is availed on all these items. Now, when you are taking the credit, when you are purchasing all these items, you call it as availment of ITC. Supposing this entire ITC availment is say 1000 rupees. You have to pay output tax of say 3000. When you are paying this 3000, how your calculation will be that your gross output tax is 3000. You will first pay it by using your input tax credit, which is 1000, and finally balance 2000 you will pay it by your cash ledger. Now this point is called as utilization of credit. This is exactly called as utilization of your ITC. Utilization of your ITC. Availment is when you are purchasing this input services, capital goods, you are booking the credit and it is hitting the electronic credit ledger. Utilization is when you are making the payment of this output tax you will first use the credit portion and balance portion only you will pay it by cash ledger. This is utilization of credit. So availment is separate thing, utilization is separate thing. Availment happens when you're purchasing the input services capital goods, or when you're having inward supply of input service capital goods. Utilization happens when you're paying your output tax. For paying output tax, you're using the credit. Rather, availment, it will first hit and add the amount to your electronic credit ledger. So when you are availing it, it will increase your electronic credit ledger. Utilization, it will hit again the electronic credit ledger, but it will reduce the amount from your electronic credit ledger. So your amount from your electronic credit ledger will get decreased. It is nothing but credit only. Electronic credit ledger means your ITC amount maintained in your GST portal. So that is electronic credit ledger. We'll be discussing much about your electronic cash ledger, credit ledger, liability ledger in your payment chapter. As of now, understand that when I take the credit, my ITC increases. When I use the credit, my ITC will get decreased. So that is all about the definition of your input tax and your definition of input tax credit. So these are the definitions which were necessary to understand before moving on to the entire chapter of your ITC.